Warren Buffett, the asset allocator, the greatest asset allocator. And we'll talk about why. And it's all about float. So what's float? In finance, float refers to the amount of money that an insurance company or financial institution holds temporarily before it is paid out or invested. Warren Buffett frequently talks about float, particularly in the context of his investment strategy in the insurance business. Here is a breakdown of what float means in different contexts. Insurance float, because there's different floats. Insurance float, for instance, for insurance companies, float is the money they collect from policyholders in the form of premiums before they have to pay out any claims. And if they don't have to pay out any claims, it just keeps building up because that's a continuous stream. You build up. If a claim hasn't happened yet, there's a significant possibility that it's going to happen at some point. This money can be invested, and the returns from these investments can boost the company's profits. Buffett's Berkshire Hathaway, which owns several insurance companies, benefits significantly from float because then it can invest these funds in a variety of assets until they are needed to pay claims. And that's the secret sauce. He used insurance companies, he used Geico to build up this cash reserve, and he was really smart in where he allocated it. Warren Buffett isn't the best stock investor, isn't the best stock trader of all time. He's the greatest asset allocator. He bought stocks, but he also bought bonds. He bought, businesses. He was able to use money in a way to make him one of the biggest companies in the world. He has more money than the nations. Like Berkshire Hathaway has more money than the nations. It could save America in a lot of retrospects. During the Great Recession, he saved America. He saved a lot of American businesses during the Great Recession. He gave them money. He had so much cash. And so when people try to downplay what Warren Buffett did, oh, he's not the greatest, stock investor trader of all time. They look at Peter Lynch, which, amazing what Peter Lynch did. They look at what's his face who just passed away from that fund, Renaissance Tech. I'm forgetting his name right now off the top of my head, but that Renaissance Tech, John Simons, yes, Jim Simmons or whatever. One of the best traders of all time. They have those. People try to counteract that, but Warren Buffett, greatest allocator, easy. General finance float. More broadly, float can also refer to any funds that are temporarily available for investment or use, which may come from various sources such as accounts receivables, cash reserves, or other temporary holdings. In essence, Warren Buffett values float because it provides a source of capital that can be invested to generate returns. And insurance float is particularly attractive because it often comes at a low or no cost, especially if the insurance company is able to charge premiums that exceed the claims paid out. That's the secret sauce. So let me give you how it all started. I read a lot. I'm actually reading a book about all the Berkshire Hathaway shareholder meetings all the way up to 2018, I believe. I'm about to be on 2017. I'm almost done with the book. I've shared it a couple times before. And what I realized about Warren Buffett, he was a great flipper. Before Warren Buffett met Charlie Munger, he was using Ben Graham's system to a T. Ben Graham's is you buy low if you can get a business or a stock lower than what it's worth, actually what you could sell it for, buy it, right? If you could buy $1 for 75 cents and you can sell it back at $1 or even more, do it. And that's what Warren Buffett was doing. And what Charlie Munger would bring up before he got in the mix, he experienced Warren Buffett buying a windmill farm. And Charlie was asking Warren, why'd you buy a windmill farm? Because I bought it for less than what I could sell the assets for. And, I guess apparently they went into the windmill farm and they brought somebody else in. And eventually they're like, dude, we can't run this operation. It just doesn't make sense. What we will have to do is sell everything. And then you can get into like private equity and, taking down businesses. And was Warren Buffett the most moral person? The way Berkshire Hathaway became, he felt like he got gypped on the buyout price for the company. And so usually for shares, so you're like, you know what, I'm just going to buy the whole thing. And so, young Warren Buffett was definitely on the wild side. And that's what people don't realize. They see a prudent investor, and of course he is, and of course he was when he matured, but he was very wild, and he was a flipper early on. When he met Munger told him, just buy good companies. Just buy good companies. Don't do anything else. And that's what he started to do. Now, so back to the float. And what I wanted to go with this was he started to buy good companies and started to get good float so he could continue to buy good companies. And it started with See's Candy. So See's Candies was the float generator before Geico. See's Candies, you think about it, whatever it costs See's Candies to make a box of chocolate, say it costs them $1, $2 to buy a box of chocolate, but they sell it for $20, especially during the holidays, that's going to go regardless because it's a gift. So you see that type of cash where, their inventory is their capital and like their assets in their factories, but they don't really have to pay a whole lot else after that. Factory ingredients, that's pretty much it. And then they just profit the margin. And that's where he was able to buy companies like Geico and other companies from the See's Candies float, from the See's Candies cash. All right. And now what Warren said, he loves See's Candy. And I think they tried to take it public a couple of times. It just didn't have that type of growth potential. It maxes out. Like float generators normally max out, and they're not always the best stocks because they can't grow as much. They produce a lot of cash, but there's something about the business model that when it comes to super scaling, it's just not there. And that's why Geico was once public as well, and it's now off the market because it kind of reached that threshold where it doesn't make sense because it can't grow anymore. It still is a great cash generator, but it's not going to grow like you want to see for stocks. And so gematria wise, we have cash flow equals 33 in reduction. Stocks float equals 33 in reduction as well. So a stocks float, cash flow, 33 reduction. We love seeing that. And then we have, look at these connections. Look at this. Warren Buffett, the asset allocator. Warren B, invested access C's cash. And Warren B, invest retained cash flow, all equal 333 English ordinal. Then you had 117 reduction for the first two, 150 reverse ordinal for all of them, 171 reverse reduction for all of them. Warren Buffett, the asset allocator. Warren B, invested access C's cash. Warren B, invest retained cash flow, 333 English ordinal, and all the other connections. Very strong. See's Candy float built Berkshire stock, 133 reduction. Parent number rule, 33. Float is retained cash flow for a stock, 137 reduction. 33rd prime, 187 reverse reduction. See's Candy and Geico Insurance cash maker, 137 English reduction, 187 reverse reduction. So you see, look, float is retained cash flow for a stock. See's Candy and Geico Insurance cash maker, 133 reduction, 187 reverse reduction. You see the connection. Geico has a better float than See's Candy. See's Candy and Geico made Buffett wealthy. They both equal 330 in English ordinal. Do you see it? Do you see it? Geico has a better float than See's Candy, which happened. Geico leapfrogged See's Candy in the float operation. It had to if Warren Buffett wanted to keep growing. And then See's Candy and Geico made Buffett wealthy, but they both made Buffett wealthy. You see the connection. And so hopefully I broke down float well to you. Hopefully I explained to you why Warren Buffett is the greatest asset allocator ever, which is essentially the greatest investor ever still. I broke down how he used See's Candy to leapfrog to Geico and to leapfrog into other things. And, a downside to Warren Buffett having so much cash is you have to use the cash or it becomes useless. So for a long time, he was invested in low capital, high margin businesses. But when you have See's Candy and Geico running on all cylinders and you're maxed out, you have to actually start using the capital you have. That's why I started getting the railroads. That's why I started getting into energy, because those are heavy capital intensive businesses, but you have to put it somewhere and you have to put it to good use. So that's what he did. He's the GOAT. Come on, he's smart. He's the GOAT. Come on now. Don't disrespect Warren.